Daily News. U.S. Treasury yields extended their gains last Friday, August 21, with the 10-year yield climbing back above 4.7% and the 30-year yield rising to 5.27%, marking a second consecutive gain. Yet all three major U.S. stock indexes rebounded, as concerns grew that a potential debt crisis could evolve into a currency crisis, intensifying fears over the dollar depreciation trade. Gold and cryptocurrencies, seen as alternatives to the U.S. dollar, rallied sharply, with gold breaking above $4,600 to hit a more than 3-month high. The combination of persistent inflation risks and reduced forward guidance from the Fed has driven investors to demand higher term premiums, pushing Treasury yields higher. At the same time, the Treasury is expanding bond buybacks to help contain yields. This creates a clear policy tension. If investors continue demanding higher risk premiums, pressure on the U.S. dollar could accelerate. Looking ahead, the Fed's stance will be crucial. Rate hikes would run counter to the Treasury's liquidity support measures, raising the question of whether the Fed could eventually adopt measures such as QE to support the Treasury. Fed Chair Kevin Warsh's speech at the Jackson Hole Symposium this Friday could provide important clues. Technically, the U.S. dollar index is currently capped by resistance at 99. While a short-term rebound cannot be ruled out, failure to sustainably hold above 99 could open the door to further medium-term downside, with mid-September a key period to watch.